Wir haben hier am Institutional Money Kongress Professor Michael Spence zu Gast. Er ist Nobelpreisträger im Jahr 2001 und Professor für Wirtschaftswissenschaften an der New York University. Mike, you have done a presentation here at the Congress and the title was Growth Engines, Prospects and Challenges in the Next 5 Years. What were the main aspects that you were treating in your presentation here at the Congress?
I think, just going around the world, I'm pretty optimistic and expressed it on the emerging economies. I think the growth slowdown that we're seeing is going to be temporary and they'll go back to a pretty high sustainable pattern of growth. That's based on an assessment of the resources they have to deal with the imbalances and challenges that they have. I would characterize the American economy as sort of a partial recovery, so there's real growth. I think it'll stay partial for some time until the government decides to start investing and some other important things. And in Europe, I think we're in for a fairly extended period of fairly low growth. Even if some important reforms start to be implemented in the South, they take time to take effect. So I think a realistic assessment is that it's going to be a multi-year process. I'm not pessimistic about the long-run outcome, but I think we have to be realistic about the timing.
I remarked that especially your graph, your presentation about unit labor costs in Europe have shown that there is some convergence in many countries, but there are also differences if we talk about Italy and France. What is behind this non-convergence, so to say?
Well, it may be that the institutional setup is on the inflation side is still indexed enough to prevent the convergence from happening. In Spain and Greece, basically you have a limited inflation environment because of European monetary policy, but there's still some, and the wages and incomes are basically flatlined, which produces over time a kind of real convergence pattern. And it's even possible, there's some real nominal declines in wages. I know that the Greeks, under extreme fiscal pressure, have actually cut public sector wages and so on. That also accelerates the convergence process. But in Italy and France, so far, even with quite high unemployment levels, there isn't so far. The data is always a little out of date, so we may be seeing it now after a fairly bad year in both of the countries, but it hasn't started to show up. But eventually we're going to have to see relatively declining real unit labor costs in these economies. By relatively, I mean relative to the powerhouses like Germany, in order for them to get back into sort of full competitive mode.
Well, the latest developments in politics, we have a new government in Italy, we have the announcements of François Hollande of a change in politics and French politics. Will that accelerate this process that you were describing?
It could very well. It's hard to know at this point. Renzi's, our new prime minister, Renzi, has been on the job for a couple of days now, so it's a little hard to know whether this is going to work. But there's some optimism that there's a real chance of a fairly substantial increase in reform momentum. New electoral law, maybe a new elected government at some point, and a mandate to undertake some real reforms. I think with the young people especially behind it. And in Hollande's case, it's a little hard to tell. He's... The first couple of years were characterized by what seemed to me to be fairly big missteps, extremely high taxes on income and capital. That didn't seem to make much sense and didn't really seem to solve the problem. Now a kind of announced movement toward a more market-friendly, business-friendly approach. If he does it, I think it will, over time, have a major effect. So I think there's reason for cautious optimism.
Let's talk about emerging markets, one of your main topics in the presentation here. You have been dealing with different aspects regarding key elements in emerging growth dynamics. What would you say are the three most important aspects that you were mentioning?
Well, I tried to make it clear that, China's really in a different category, not just because of size, but because of the relative closedness of its capital account. So China has real risks and challenges in implementing a fairly massive change in what they call the growth pattern and the reforms that underpin it. I think there's two parts to that. One is whether the shadow banking system is out of control and will derail the growth engines in China. My answer to that is probably not, based on the resources and competence and alertness with which they get on top of problems. And then there's these big reforms, and I tend to be on the optimistic side about that. That's good for the whole global economy and the rest of the developing countries. And on the other side, on the major non-Chinese emerging economies, systemically important ones, all of them have a rebalancing to do because they got, in some sense distorted by monetary policy in the West. And they have to rebalance in the right way, probably raise interest rates, they'll slow the economy down, they'll raise domestic savings, they'll have a bit of a hit. But over time, it should, I think, right the ship. And most of them, I think, will get this job done. Now, these countries every country's different, Hans, and they have idiosyncratic, mistakes, challenges, and other things. India is going through a major election. I think it is a widely held view that in its final years, the Congress Party and its coalition really lost the reform momentum, and I think India's future economic performance will depend on whatever new government comes into being after the election, restoring that momentum. India is not a country that can sort of coast on its, past or its resources for very long. It needs continuous reform momentum to keep it going. It doesn't have a balance sheet that looks like the Chinese one. They don't have big buffers that absorb shocks and so on. Brazil, I think that President Rousseff got a bit of a shock when these demonstrations came along, and is in a process of learning that maybe the government got a little isolated and technocratic and distant from the people, and probably is righting the ship in that dimension. I worry about Turkey. Turkey is a rather important economy now with a very high performance track record. But I think there seem to be, and I'm not an expert at this, real underlying sort of political problems and divisions, between the Islamic government and the secular part of the population, and I don't know how that's going to work out.
What seemed a little bit contradictory to me is the aspect of declining disposable income, high savings rate. I'm talking about China.
Yeah.
A high savings rate at the same time, which leads to a rather low consumption on the one hand. On the other hand, you have that aspect of growing middle income class in China, which would be a positive development for a country like China.
No, it's very confusing. So that's right. Even on autopilot, they'll generate a very large number of incremental, additions to the middle class. That won't necessarily generate enough demand of the right kind, and so they have market forces as a tailwind. The wages, especially in the coastal areas, are rising very, very quickly, faster than GDP. On the order of 15 to 20% a year, starting a couple of years ago. That's hard for the businesses whose costs are rising, but it's very good for the economy and its transitions. But the other piece is policy. They need over time, with the help of these market tailwinds, to get a larger fraction of income in the hands of households. I think this means using state-owned enterprise income to fund the government, which hasn't been true in the past, and then giving it back in the form of tax reductions or through other channels to the household sector. This is where in China the ideological battle comes in. There are people who want the state to be big and dominant, and the notion that its share in the economy, its share of income, its control over resources might decline over time is something that not everybody wants. So this is a battle to be fought and either won or lost in the next few years.
The question that every investor, especially institutional investors here at the Congress, are asking themselves, will the convergence of developing countries via sustained high growth continue, or in other words, is the growth story in emerging markets over?
Yeah, I think the answer to that's clearly no. I mean, it may be slower than we thought. Nobody really predicted the magnitude of the hiccup that came with the rapid inflow of capital and then the rapid outflow that started with the tapering announcement last year. But I don't think it derails it, you know. And in the scheme of things, you know, this convergent process is a multi-decade process. It may slow it down a little bit, but I think that the talk of it being a whole new world where the emerging markets aren't going to grow anymore is overdone.
Mike, thank you very much for being with us here in Frankfurt at the Congress. Thanks a lot.